I don't believe you're going to have a massive decline in home prices very quickly like we did from 2006 down to, to maybe 2011, 2012, as that rolled out. I think that there's enough strength and enough reasons that it's too unaffordable to let your house go versus renting, that people will hold on to that house, and that's going to keep supply constrained.
As someone who's accused of being a housing bull, I wanted to do a video about the two ways, yes, folks, two ways that we could get a national housing price crash. And again, let's define crash. 20% or greater would be a national housing crash. I do believe there are two ways that we could see the median home price fall by 20%. We're going to have this conversation with Anna Kelly, somebody who survived the GFC and up close and personal on all things housing. How you doing, Anna?
I'm doing great. This is a great question. I think lots of people have opinions and thought that housing would crash over the last couple of years, and surely transactions did. The question now is, will values? And if they do, how much? And what's considered a crash? And what part of the country are you talking about? I think there's lots of nuance here. So I'm interested to hear your thoughts.
Yeah, so I had a plane ride back from Orlando where I spoke at an event, and everybody's talking why home prices haven't crashed nationally. And so I spent the 4 hours or whatever it was flying home kind of articulating how it could happen. And I come up with two different ways. So let's be very clear. National median home price could crash 20% or greater. So scenario one. Scenario one is most similar to what you and I saw in the GFC. I believe most doomers and crash bros who do this for clicks don't understand the process and the length of time that would be required for this to cause a 20% crash. But the story goes like this. The economy goes into a deep, dark recession. I'll call it 4 to 6 quarters, so deeper and darker than most. We see unemployment spike to over 8%. And we have a lot of people who suddenly can't afford their houses. Again, if you understand the process of housing, you go 90 days without a payment. You can get what's called a notice of default. And then in best cases, somewhere between 90 and 120 days, you could actually have a foreclosure. So in the most efficient states, in the most efficient cities, you are talking about a foreclosure occurring 7 months after the first missed payment, right? Best case. However, if we've learned anything from the GFC and certainly the pandemic, if we were to go into this deep, dark recession, the government would once again step in and give some type of relief, right? Delayed payments, workouts, all of this, right? If we're in a deep, dark recession, the government will step in, no doubt, every time. They do not want to see GFC 2.0.
Right.
They don't want that. They did that before and it sucked. It didn't work. However, what would happen, in my opinion, is if a deep, dark recession, or dare I say depression, occurs for a year and a half, maybe goes out to 2 years, we will start to see foreclosures actually occur, right? Banks will eventually stop extending and pretending. You can't, you can't do this forever. So probably at the year mark of this deep, dark recession / depression, foreclosures start to rise and probably rise substantially. And as you know, once those start to happen in greater numbers, they go from today 2% of the market to say 30% of the market. And yes, folks, it has to be that meaningful. You're not going to cause a crash with 1 or 2% distressed. It's got to be 20, 30, 35% or more. You will start to get comps and you will start to cause deterioration in price. And then the other thing that needs to occur is inventory needs to explode. Today, according to Mike Simonson, we're at 860,000 single family homes for sale. We've got to get to something like 2 million. 30% of those, so 600 grand, have to be foreclosures or short sales. It's got to be that distorted.
Right.
So the first way we get a national housing crash is a horrible economy that lasts years. Banks do what they do, but it doesn't work. It can't save. Inventory doubles or triples. And then we start to see price degradation. So in my world, in scenario number one, home prices at the national level don't see really big hits until late 26, but probably 27. So the deep, dark, painful value price, because again, there's this thing called price elasticity.
Yes.
I don't think we see any degradation, meaningful national degradation, until 2027. How's that scenario play out? What do you think?
Yeah, it would have to be a really, really deep, deep, diffuse recession for sure, or depression. And the question is, what is the Fed shown us they will do? What does the administration tell us that they would do? So one of the issues is yes, in terms of prices right now, home ownership is out of reach for a lot of people that don't yet own them. However, those that do own the homes, the vast majority, and the numbers keep changing, but the vast majority have significantly lower interest rates than what we will ever see again, unless we do have a really, really deep, diffuse, meaning very broad across all sectors, recession or a depression, something like the GFC. Even if they did, though, here's what's different this time from before. Two different things. One, most of those interest rates, those homeowners that are in homes today, when we look at supply, they're now fixed. There were many, a huge percentage of homes that were doing ARMs back before the 2008, 2009 great financial crisis. And so many people had not only prices that went crazy because of what these low interest rate and no doc loans allowed people to get into, but they were adjustable rate mortgages. And so their payments jumped at the same time that we had a mass increase in layoffs. We won't have that similar situation today because most of these loans are fixed. Not only are they fixed, but they're fixed at these historically extremely low rate. I mean, Michael, my house is 2.3%. My second home is 2.6%. Lots and lots of people have interest rates below inflation today, right? And so they would be crazy to stop making their payment on their home. They would let their loans, their student loans go, their car loans go, their credit cards go, et cetera, before they would get rid of their home. The other thing is the cost to rent is now about 40% cheaper than the cost to own. So the reality is, if somebody did lose a job, and let's just say bad recession is 10% of the population is laid off. 90% are still working. Okay. So for those 10% that are laid off, it's a lot, but in terms of how many of them own homes and have equity in their homes that they could tap, or, some savings, those on the higher end that own homes typically are going to be okay for a few months and have an unemployment that goes through. They might get this forbearance on their house. If you were faced with a job loss and you had an interest rate of 3 or 4% and you were forced to sell your house, you might have to rent a 1 or 2 bedroom apartment. And it will cost you the same as the mortgage payment on your 4 or 5 bedroom house. So it is the dumbest thing people could do, even if they're laid off, is to sell that house, which holds their equity. It's like the last case and last resort. So the question is, how many people are in that position such that the supply does skyrocket to the extent that you're saying, such that prices radically and drastically fall? So the time horizon, even with all of that said, by the time you get through those forbearances and that, let's just say it's a 10% unemployment rate, and the Fed comes in and rescues and gives you options, usually by then, historically, an average recession is 8 to 10 months.
8 to 10 months.
A really bad one is 18 months.
Right.
Most of that time, by the time you know it and employment spikes up, you're already through most of the recession. And it's just when it becomes obvious that there's a recession. And then you're into a 2 to 3 year recovery period. And so it would require a massive destruction of employment, larger, I think, than 10%.
And it's the duration. It has to be a long duration. It can't be a 6 month recession. Because forbearance will be 6 months easy. So
easy, or even a year if they go back to doing things like COVID did. And with the administration coming out and saying, we're really concerned about housing, we're really concerned about unaffordability. They don't want people to lose their homes, those that have them. They want people to stay in their homes, and then they want to help people that can't afford them to get homes. And so I don't think that they would allow such massive destruction of home values Now, some could argue that would make it more affordable, but at what risk to the overall economy? So I don't believe, to your point, I like this. I like what you're laying out. And with all these things said, I don't believe you're going to have a massive decline in home prices very quickly, like we did from 2006 down to, to maybe 2011, 2012, as that rolled out. I think that there's enough strength and enough reasons that it's too unaffordable to let your house go versus renting, that people will hold on to that house, and that's going to keep supply constrained.
Yep.
Now, when we say over and over, housing is very local and regional. It's not really one national housing market. We like to look at it that way, but the reality is it still all comes down to supply and demand. Everything is supply and demand. So you look at, yes, I want to pick Florida, for example. I have properties in Florida. I have investment properties in Florida. Florida's becoming pretty unaffordable with increases in insurance. That's the main cost, plus your taxes. And so, you see a lot of increase of supply in markets like that. The question is, where's their demand for it? And do the sellers have to sell? While you may have markets like Florida that really could see big, big price drops, and we have seen price drops in a lot of states. I think 30 something out of 50 states have slight declines in prices, but this is over like 2 to 3 years of a transaction recession. I think by and large, you're not going to see that. And the other thing is, Michael, most of those places that prices are starting to tick down, they're places where people have second homes and investment properties. But when you look at the aggregate of what percentage that is, I mean, only about 10% of real estate today is owned by investors. 90% ballpark is owned by homeowners. And so even if all the investment properties went bad in Florida, you still have 90% owned by homeowners who by and large were wealthier and may be able to weather a few months of this kind of decline. So I just don't see any kind of massive crash, but I do believe that it's very possible that we might lose, nationally 5-10% of value at the worst case, but that's very short-lived just because of the lack of supply and the lock in the fact that's going to keep supply down versus all the money on the sidelines that we talked about in the first video, $7 trillion worth of investors waiting on the sidelines, that if the economy crashes and they want out of the market, what are they going to buy? Hard assets. What's a hard asset? Real estate. So you might have less sellers, more buyers. And what does that do to prices? Pushes them up, not down.
Yeah. So again, kind of scenario number one for me is a deep, dark recession, certainly longer than most, probably has to be 18 months. We have to have the unemployment rate over 8%. And I do think double digits would probably be a big part of this for a long time.
Right.
It has to be so deep and dark that a 6-month forbearance gets consumed, if not a year. So, I mean, it has to be a deep and dark one. And you're absolutely right. The biggest difference to me that most people miss when we're calling a housing crash because of foreclosures and short sales and a bad economy is the cost of shelter. Very much the last cycle had variable rate debt. And when it reset, it was 3x rent. Today, many people are half of rent. So they don't want to down select. In fact, they'll get roommates.
No one's talking about that. And it's huge. It's a huge difference from before.
Okay. All right. So that's scenario number one.
That's not going to happen. But it's a good thought. Lots of people think could it happen? Anything could happen. Probability. You always ask me, what's the chance? 20% chance.
Yeah. Maybe so here's the second one. Here's the second scenario. I've actually believed this for quite a while. And part of this is a setup to how I got the current housing market right. We had a transaction crash. The low end of the market's not transacting. The move-up buyer's not participating, now called lock-in, all the things that we've talked about on this channel. So in order to get a significant price, again, I want to be clear because this is going to be this is going to geek out on math. In order for the median home price to fall, we have to instantly flip and ignite the move-up buyer. So we have to see a flood of low-end homes come on the market. Now, I know of 2 ways to make that happen. The first way is you snap your fingers and mortgage rates, to your earlier point in scenario number one, are now 2.5%, 2.8, 2.9. You basically have to take away the lock-in effect, right? We've had 3 years of transactions being cut 40%. That's building pressure. People want to move, but they're trapped. You know the story. But if mortgage rates were wink, wink, nod, nod, 2.5%, that goes away. And I believe we would see a flood of entry-level housing. Now, again, these people are move-up buyers and they will, sell and buy. But I do believe that just the simple math distortion of taking a wave of low-end transactions where it didn't exist before will just magically pull the median home price lower. There's a second way this could happen is you could actually create a tax incentive to sell your home to entry-level housing, to first-time home buyers, right? Anything that you do to distort or unlock entry-level housing, if it's done in a very short window, let's say the tax savings, for example, is 6 months only, right? You have 6 months where if you sell to an entry-level house, no taxes, as an example.
Mm-hmm.
That would be a flood of inventory, predominantly at the low end, that would distort the numbers once the transactions happen. So again, one way to do this is via tax incentives or slashing interest rates. Probably sub 3.5 certainly does it. What do you think of that option?
Yeah, it's interesting, and I feel like I need another cup of caffeine so I can process everything that you just said. But I think that the thing that might keep that from happening, Michael, is just how fast can you create new inventory of entry-level housing that's actually affordable? Because the costs to build have gone up and they continue to go up because of, and there's talks about not having tariff on steel and lumber and windows and, the things that are needed to build a house. And the administration could pass policies to make it less expensive to build. But the reality is even the cost to build an average entry-level house is pretty high. And I think you'd have to have so much clear demand to incentivize the home builders to do it.
Well, again, I'm not talking, if I said home builders, I'm mistaken. We have to unlock the move-up buyer who is sitting in a home that they didn't expect to be their forever home. And we have to give them a reason to buy. So this isn't about new construction. It's about existing homes.
Existing home sales. So yeah, the question is just, and again, I agree. We'd have to do that. The question is, would the next level buyer up, be willing to sell and move up as well? It has to have that kind of trickle up effect. And generally speaking, if rates are really, really low, it's bad news for the next couple of years of the economy. And so those that are poorer are going to have a harder time buying unless there's huge government incentives, not only at the low rates, but like no down payments, USDA type of loans.
20K tax credits.
Exactly. So that could increase demand. But if you don't have the supply increase enough because there's enough bigger houses for people to buy, then it doesn't necessarily fix the supply side issue, that lock-in effect. Because those that if rates are low, it means the economy's in the tank. And so that generally in and of itself has enough, impact on the consumer psyche that says, we're in a recession. This might not be time for me to move up from my entry level house to the next house. And it might not be the time for someone in a medium price home to move up to the next one because their stock market portfolio is down. They feel poorer that's gone. Their 401k is down because that's what happens in recessions. And it usually rocks the consumer that you move from this irrational exuberance that I would argue that we're in to consumer confidence going lower and lower and lower. And that's why even in recessions, and even if you have all these low rates and incentives, it doesn't usually move housing significantly other than for investors, because the average American finally has scarce. They're finally scared. They're no longer confident. They
pull back.
My neighbors are losing their jobs. I work at a restaurant and I've made really good tips, and now my tips aren't coming in. People aren't eating out as much. They get afraid to spend money on things like a house at that time. And so I think that just looking at previous recessions, Michael, and how people act and already seeing consumer confidence kind of come down, I don't think it would happen quickly. That's my point. It can happen as the economy starts to recover. So a lot of this depends on, if rates were slashed, but the Fed held rates low and we have a period of QE that lasts a year, 2, 3 years to get us into a recovery. It's when you get into that later part of that recovery, year 2 or year 3 after a recession is declared, that people are like, okay, I can breathe again. So maybe in that point, we start to see some of that move up, but I just don't think it happens broadly and rapidly enough to cause that to happen.
Yeah. Again, I was really thinking about what would cause
Yeah.
national median home price to fall.
Yeah.
And really the answers are kind of twofold. One, a deep, dark recession that ultimately has to end with slashing prices because you've gone past forbearance periods. It's got to be long, or you have to do something to unnaturally distort entry level housing. Right?
Yes.
Tax incentives, interest rates,
Yeah.
whatever it is. You have to
Yeah.
unlock the supply. And
Yes.
again, that's just how the median works, right? It's in the middle. If you suddenly incentivize low end, below the median transactions, it will naturally pull the median lower. Just like we've seen artificially, when the low end isn't there, it's pulling it higher.
Right.
So again,
Right.
this is just how math works.
I like that you started this out with, time. It's not just the numbers. It's not just the what could happen. And yes, the reality is that housing is unaffordable. I mean, one of the most unaffordable periods ever. You have to make about 50% more to own a home than to rent today. But renting costs you about 37 to 40% more than your current payment. And so, those things take a really long time to unwind. And I've been learning in real time the impact of long and variable lags in the economy. And so anyone that thinks you're going to have this rapid melt up or rapid meltdown, the things just don't roll through the economy that quickly anymore. And so it takes a long period of time. And so, do I believe that housing prices could adjust downward closer to the mean over time? Yes, they could. But there's just as much likelihood that by the time that they start to do, there's so many programs and incentives that bring them right back up to where they are. So if I had to guess, I would guess, we're going to have more of a flat housing economy for a while. Prices are just kind of flat. Some markets go down more, some markets go up more, but it's going to take years. Those waiting for crash are hopeful thinking. And those, thinking you're just going to have a melt up, I think they're hopeful thinking too. So, all these things are really important, but it's just important to do good deals, buy good homes at a good price.
Do the work.
They'll come down, they'll come up, but don't listen to the extremes, because the economy, it works very slowly. And what I've learned not that I necessarily like it, but if you look at history, Michael, these cycles play out very, very similarly. The government has gotten faster, and I'm putting in air quotes, better at keeping us from having deep, deep recessions. And they will come in and they will do whatever it takes to keep any portion of the economy from really crashing. Because one thing that's important, like we said last week, housing leads you in and housing brings you out of recession. So if housing crashes, many, many, many more job layoffs come, and the recession gets deeper and deeper and deeper. And I don't think the government's going to let that happen, quite frankly. So that's why I don't believe your scenarios are going to happen, even though you're trying to show people yes, things could happen. We can be doomy instead of, propping up housing. But the reality is it's very unlikely that you're going to have the deep, deep, deep recessions and deep, deep, deep housing crashes that you had in the past.
Yeah, at the end of the day, I wanted to put this together because, again, I get called a housing bull, which, to your point, I get called a housing bull because I say prices are going to be flat for 5 years. That's a bull. I don't understand that, but apparently I'm a housing bull by saying prices will be flat for 5 years, because I do believe, just like the 80s, we got a lot of our appreciation in the first 2 or 3 years, and it's going to take 5 to 8 years to kind of work out of this unaffordability. The answer is time.
Absolutely.
So, folks, let us know in the comments below. Do you see a third way we could get the median home price to crash 20%? This should be interesting. Anna, where can people find you?
You can find me here on your show on social media at Anna Kelly RMM, and for coaching and consulting at AnnaKellyInvesting.com.
You're amazing. Take care. Have a great week.